This is Chapter 8, Part 2. So if you will flip from your page 1 notes and go to page 2. So in the prior video, we looked at how to record the asset when you acquire it. Now we're going to look at depreciation. Well, what is depreciation? Well, it's where we actually just allocate the cost of the equipment over its useful life. And so we had gone over in the earlier video, you acquire the equipment, then for years and years and years we use it. This is where we're going to depreciate it, and then finally we'll look at disposal. So we're going to look at depreciation, and then there's other words. If it's a natural resource, we deplete it. If it's an intangible asset, we amortize it. But all of these are merely allocating the cost of the asset over its useful life. Notice it's not how long the asset can physically exist. How long do we intend it using it? Okay, what makes it unique is that we are going to estimate because we really don't know really how much we're going to use. All right, so let's go to a demo problem. So skip through that, and here we are, recognizing depreciation throughout the years. So our the entry, and it is going to be an adjusting journal entry. So again, it will be an adjusting journal entry. Those are at the end of the accounting period. If the accounting period ends on December 31st, then those will be dated December 31st. We debit depreciation expense, credit accumulated depreciation. We've made this journal entry before. And then on the balance sheet, we'll see the original cost of the asset less the accumulated depreciation. We are going to cover the straight line method. I have another called an accelerated method, double declining balance. We actually aren't going to go over that in Chapter 8. We will not cover it. But here at the tail end, I am going to address it slightly because I want you to know the big picture, but not the detail of double declining balance. So I am going to go over the big picture. If we were to use it, what difference would it make? Okay, so let's say again, here we are back in our prior example where we bought a saw for $157,700. And essentially, the equipment account had a number of debits, with those totaled $157,700. Cash went out $157,700. So we had a bunch of debits to equipment and a credit to cash, $157,700. Okay, so now we have this in the equipment account. And that would have happened on January 1. So January 1 was this journal entry. Now it's December 31st, and we need to record our adjusting journal entry for depreciation expense. So cost is what's in this account, right? The original cost. So that cost is $157,700. Then the company expects to use it for 5 years with an estimated salvage at the end of those 5 years of $7,700. Salvage means we are just kind of guessing that we can salvage or sell it for $7,700 at the end of its useful life. So we will subtract the salvage value because we're thinking we're going to get that back. So the total amount we want to depreciate is $150,000 because we think we'll get the $7,700 back. Okay, then with straight line depreciation, if I want to depreciate $150,000 or expense $150,000 over 5 years, that's going to be $30,000 annually. Okay, so let's make our journal entry. We will debit. I'm just going to abbreviate depreciation expense. And I am going to drop drop the thousands because I don't think I can get 30,000 in here all the time. So I'm going to put 30 in there, but I really mean $30,000. And then we would credit accumulated depreciation, and again, I am just taking this journal entry and plugging it in. Debit depreciation expense, credit accumulated depreciation, and that would be our journal entry in year one. So in year one, we have equipment, $157,700, depreciation expense of $30. Let's go look at what our financial statements will look like. So we would have $157,700 in the equipment account. Then we just increased accumulated depreciation $30,000. So it would have a book value of $127,700. So we net that value on the balance sheet. On the income statement, we recorded depreciation expense of $30,000. There was no cash out to spend on it, but we did pay cash. Right? We paid cash out that to buy the asset. That was an investing activity. So $157,700 to purchase the equipment. Okay, so there we go in year one. Nothing happens to the equipment account, by the way, so it will stay all along. The original cost was $157,700, and that will stay in that account until we sell it, unless we do something really unusual to it. But generally, the original cost stays the same. Okay, so nothing happens to the equipment account. It stayed at that $157,700. Okay, remember, depreciation expense, like all expenses, gets closed. Oh, I didn't write that right. Gets closed to retained earnings. I'm going to put RE here for retained earnings. So that depreciation expense, like all expenses, gets closed to retained earnings at the end of the year. Okay, so a whole nother year will go by. We will depreciate $30,000 again at the end of year two. So again, for year two, this is the only journal entry for the equipment. So nothing happened to cost, but accumulated depreciation will grow to 60. 30,000 was in there at the end of last year. We just added another 60. So book value will go down to $97,700. We also recorded another $30,000 of depreciation expense, but we didn't have any cash out here in the second year. All we had was $30,000 of depreciation expense. We increased accumulated another $30,000. So it went from 30 to 60. Okay, and you may get the hang of this. A whole nother year goes by. We are going to depreciate that equipment another $30,000. Remember, depreciation expense gets closed each year, so it does not grow. It's going to be 30, 30, 30 each year. But the accumulated depreciation is on the balance sheet. Balance sheet accounts do not get closed. So there's 60,000. We just added another 30. Now it's going to grow to $90,000. So now the book value is $67,700. 157.7 minus 90, 67.7. And again, there's no cash flow in that depreciation entry. That's the end of year 3. Okay, remember we closed this $30,000 depreciation expense to retained earnings, so it'll have a zero balance when we start year 4. All right, year 4 takes place December 31st rolls around, and we're going to make a journal entry to depreciated $30,000. So we will have depreciation expense of $30,000. We will add $30,000 to accumulated. It will grow to $120,000. 157 minus the 120. Now the book value is $37,700. No cash outlay. This expense gets close to retained earnings, so it'll start off with a zero balance. A whole year goes by. In year 5, it's December 31st, and we make our journal entry of $30,000 for depreciation expense. So year 5, $30,000 of expense. Accumulated goes up $30,000 to $150,000. Now the book value is $7,700, and there was no cash flow. Now, let's pay attention to this $7,700. We've seen that number before. That was salvage value. So, at the end of the asset's useful life, its book value will equal the salvage value. That's what the accountant is trying to get to happen. Book value will equal salvage value.